Well, good afternoon. Good afternoon and welcome to another Webinar Wednesday hosted by the Cal State Bakersfield Small Business Development Center. I'm Kelly Bearden. I'm the director of the center and your host today. I got a great webinar for you. Webinar number 290 here on September 13th, 2023. Thank you for joining us. We will get going right now. Coming up in the next couple of weeks on Webinar Wednesday, next week we will have local marketing, shop local, be local, with our friend Lonnie Lott. Lonnie will also be making 2 appearances in seminars that we are co-sponsoring with the County of Mono's Economic Development Department. So we will be on September 19th, we will be in June Lake, California, and also on September 21st, Bridgeport, California. 2 great communities in the Eastern Sierra next week. Contact, your local economic development professionals or us for more information on those particular in-place seminars at noon, those particular days on the 19th and 21st. And we'll be back with Webinar Wednesday on the 27th also, and talk about the new Community Development Financial Institution, the new CDFI lenders in this particular region by Valley Strong Credit Union with Deanna Blaze and Shantae Smith. So that's what's coming up on Webinar Wednesday the next couple of weeks. But what's up today? Today, September 13th, 2023. Well, the first thing I got to do is I got to give a shout out to our people here on Webinar Wednesday. Big thanks to Maureen Busher-Dang, our producer, and Iris for actually stepping in for me 2 weeks ago, and when I was a little bit down under the weather. So a big thanks to the team here at the SBDC for doing the webinar. Last week we missed you, Labor Day. We took the Labor Day holiday. And so big thanks to Maureen and Iris for really holding the fort together and really producing a great webinar for you. But up today on September 13th, we're going to provide a snapshot of access to capital today. So, we're going to look at rates and some of the childcare situation that's happening in California from our resident economist, Dr. Mark Evans. Our Capital Quarter segment is going to be on continuing, and we're going to be talking about another tip on accessing capital for small businesses out there. The city of Bakersfield has a grant program, and we're going to provide you an update on that, and very quick disaster update. If you recall that back in February and March, substantial amount of rainfall, winds and snow created a lot of disastrous situations, flooding, winds, you name it, snowfall, they all happened. And we're still going through some of the aftermath of those particular storms. So a quick disaster update. We'll look at our community calendar as we're continuing into event season. So we'll look at our community calendar and see some of the events coming up that you might be interested in. As always, we'll take your questions. We'll answer them live. Today's resources will be in our chat box. If you have a question, go to the Q&A box. We'll take questions at the very end. And a very limited poll for today. One question, kind of tied to our topic today, but it is one of the questions that is answered by the Federal Reserve in their report on what I'm going to say is the non-employer firms. Sarah Sims will be with us later to talk about employer firms and a lot of the data that is generated and a lot of the information. But our poll today is going to have one simple little pop quiz type question, and we will get to that right now. So on this particular poll today, our poll question today, which doesn't want to seem to cooperate, isn't cooperating at all. Let's talk a little bit about capital today. We're going to be talking a lot, and we have our little segment here that we go to called the Capital Quarter. And so basically it's the debt ceiling for small business. Several months ago, we all went through this particular crisis at the federal level with the debt ceiling. And then we came up with the notion that, hey, what is the debt ceiling that is keeping you? What are some of the factors and some of the issues that can limit you from raising capital? And here are, 7 of the ones that we've came up with over the last, say 2 months or so. Everything from not understanding your debt to equity financial ratio, to maybe minimizing your taxes that can affect your long-term funding by not showing enough profit on your tax returns. So those are some of them. This week, we're going to talk a little bit about, just quickly, about underestimating your options and potential. And it's one of the things we see here at the SBDC fairly frequently, is generally there are a lot of options and there's a lot of potential, particularly sources of funding that can come from alternative sources. So there are a lot of, and we're not saying if you come into the SBDC that there is funding for everybody, that there is, some ideas and projects maybe aren't going to be accepted by a great deal of the funding public, but understanding your options, understanding your options that you have as far as a debt source, maybe raising funding through capital, like crowdfunding. Crowdfunding is a great source that is underutilized. And also the potential that you have to raise funding from alternative sources. And we've talked about a lot of the alternative sources. So not to get into everything so deep today on the factors that can limit raising, but really you need to understand that you have more options. And if you're told initially no from a particular lender, that there are other options out there. You might not have been talking to the right lender. You might have banked with a bank for 30 years, but that doesn't mean that they're going to fund your particular business. And so just understanding that you have options and potential. And really another thing that we talk about is, if you're in a near bankable situation right now, it's not too long from now when another year is going to turn on the calendar, or you're another 18 months. And by projecting and really getting your business in shape now makes it much more fundable in the near future. So that's our capital quarter for today. Moving on to our entrepreneurship grant program that's being authorized and executed by the city of Bakersfield. And a little bit on that particular program is they have $1.5 million available, and these funds come from the ARPA program, the American Rescue Plan Act, and it had $1.5 million in grants available to 163 businesses in the city limits. They're first come, first served. Really, it is designed to be funding for businesses in qualified census tracts, typically located in the central part of Bakersfield, the eastern and southern areas for most areas. But also there is another way that you can be eligible by actually your income and qualify on income. You need a training class to complete, business plan, and also a little bit of consulting. The SBDC can help you there. You can still sign up and meet with an SBDC advisors. There's our website address, or you can call us at 661-654-2856. So again, the city program is still going, and I think it's time to bring in our resident economist. Who's got a resident economist out there on a weekly live webinar program? Well, we do. And so Dr. Mark Evans is a emeritus professor at Cal State Bakersfield, former economics department chair, former associate dean of the School of Business and Public Administration, over 40 years at CSUB, co-founder of the Current Economic Journal, and a recent 2023 inductee to the CSUB Faculty Hall of Fame. We just refer to him as the GOAT. Dr. Evans, come in and take it away, please.
Thanks for spending lunch with us today. We're going to briefly touch on two things today. One is the Federal Reserve's Open Market Committee is meeting next week to discuss interest rates. So we'll talk about that a little bit. And then secondly, the state budget was recently approved. So we're going to take a look at those aspects of it that pertain to childcare, because there's some major things happening in terms of childcare funds for the country as a whole. So as you know, if you've been tuning in on Wednesdays, the Fed met twice this summer in June and July. And in the June meeting, the Fed said that they expect to have to make 2 quarter-point rate increases during the rest of 2023. They followed that up in July by increasing rates by the first quarter point. So that leaves us 3 meetings, the September meeting next week, and then October and December, where if they have not changed their mind since June, we will see a 1/4 point rate increase in one of those meetings. So let's take a look at what's happened since the July meeting to really form an opinion on whether that rate increase is coming in next week in September. The cells that are in red font highlighted in yellow are the important changes or data releases that have occurred since the Fed's last meeting in July. And as you know, what they're most closely following are labor markets, where they would like labor markets to create a little bit of slack to bite into the wage price cycle, and then the actual inflation rate, which they'd like to get down to about 2.5% or so. Okay, labor markets, job openings. There were 8.8 million job openings in July. That's well above the pre-pandemic peak of 7,600, but the trend is good, where they've declined by 338,000 in the last month, and also a pretty nice decline in June. New hires are sitting right about the level they were pre-pandemic. But again, the trend has been negative, which normally we would think is bad, but it's good if the economy's overheated. The quit rate, 2.3%, is pretty much now it's returned to normal. It was a really high it peaked at a really high 3% coming out of the pandemic. Actual employment, it grew 187,000 last month. That's pretty close to the 190,000 average, the 12 months pre-pandemic. However, the Fed would probably like this to be a little bit lower, maybe 150K or so a year. The unemployment rate has ticked up. And then most importantly, if you look at the inflation rate as measured by the PCE core index, which we know is the Fed's favorite, just in the second quarter of the year compared to the first quarter, if we annualize that change in prices, we come up with about 3.7%. That's just it's getting close to the 2.5 that the Fed's looking for. So what's going to happen in September? Well, I think the case for an increase is that the GDP has been running much hotter than the Fed would prefer. They're probably trying to bring it down to 1.5% or so annualized, and it's running more like 2 to 3. But the case against, it's clear the labor markets are gradually cooling. Inflation in the last quarter was behaving nicely. It's really coming down nicely, but we don't know if that's noise or a reliable signal of a fundamental change. And then most importantly, when the Fed tightens, it slows down the economy with a lag, and there's additional cooling that's not yet reflected in the data that will occur. So my expectation, and it pretty much mirrors most people's expectation, is there will be no rate increase in September. Furthermore, I'm thinking that the previously expected rate increase, in other words, in June they told us there would be one more this year. I think that's not a sure thing anymore. I think they're going to be taking a wait and see attitude, and it may in fact be the case that they think the economy is cooling sufficiently that they don't need that last 1/4 point increase. Let's look at childcare because there are some headwinds here in the labor market. As you all know, especially if you have young ones, there's tremendous shortages in terms of childcare availability. The prices are high. Both workers and providers are leaving the industry, the long-run secular trend. And so in general, the industries, we've got problems. Another big change is that during the pandemic, the federal government threw a lot of money at the states in terms of childcare. For example, in California, we receive 6 times the amount of federal funding for childcare as we normally receive. Now, this has had a positive effect on the labor market. Prime age women's labor force participation rate is near an all-time high. It's roughly 77%. However, this end of a federal pandemic funding at the end of September is likely to affect about 1 in 3 childcare programs. will lose funding of some amount. And this is forecasted to end up creating about 3.2 million fewer slots for children. Now, all the states will be affected because the amount of aid was so huge in its ending. Timing and the extent will depend on the state. It will vary from state to state, depending on whether they have federal carryover funds from other sources that can be used, and as well as the state's commitment to using whatever resources they do have in their state budgets for backfilling the loss of the federal dollars. This obviously has some macroeconomic implications in terms of access, prices, and then in return, labor force participation, which hopefully will not lead to the continuation of problems you have as small businesses in terms of hiring and retention. Hopefully, it won't redouble those challenges, and hopefully, it won't make the soft landing a little bit more complex. Now, as far as California goes, what our state government does is it funds a specific number of slots based on politics, and it funds a subsidy per slot, again, depending on what comes out of the legislature. Now, the number of funded slots is way less than the need. The subsidy is way less than the cost for obvious reasons. There's a budget shortage. There's not enough money for everything we want to do. So this federal money was very important, and that it more than doubled the number of slots that we subsidize in the state of California. But again, these were one-time dollars that are ending. Now, what happened in the 2023-24 budget is that we, until the end there, we had planned to increase the number of funded slots by 20,000. We backed this out, but it's not likely to actually cause a decrease because the slots we previously funded, many of them were not yet filled because of either licensing lags, worker shortages, or the simultaneously increase in pre-K or transitional K availability. We do have some carryover funds in other areas in California. So what the government did do to a large extent with these carryovers is continue waiving the family co-payments for childcare, which were set to end, and then increasing the reimbursement rate for the home provided childcare providers. That's roughly 28% of the kids that are in licensed facilities. And then simultaneously, we increased the capacity of a pre-K or transitional K, whatever you want to call it. So I think in California, this phase out of federal funding is likely to have a limited effect on your small businesses in terms of hiring and the macroeconomic impact in California and in 2023-24. In other states, you might start seeing the effect in 23-24. In California, I think we will see increased challenges the year beyond this fiscal year. So let's look at the out years. We do have the budget constraints. Whether we have a recession or succeed in a soft landing, there's slower growth ahead either way. There will be a depletion of these one-term federal funds after the current year. In 2019, we unionized home-based childcare providers and simultaneously committed the state to full cost reimbursement negotiations, to changing the formula to where it fully reflected costs. Now, the problem with this, I think it's well intended, but collective bargaining, it can't negate the overall budget constraint of the state, or in other words, the total number of taxes citizens are willing to pay. So if through collective bargaining this reimbursement rate is increased, I think the risk is that the number of subsidized slots will decrease, or they'll be decreasing in other related areas such as transitional K to match the availability within the budget or the actual appropriation. So I think 23-24, it's going to be more of the same. Whatever you've experienced as employers or as parents, you're likely to see something similar in terms of the trend, but it's possible a bad situation could get even worse in 24-25. With that, I'll pass the baton back to Kelly.
Well, thank you, Doctor. We'll see you in a couple weeks. Interesting stuff. Didn't talk about that inflation rate going up today, though, did you? Okay, so maybe next time. So moving right along. Okay, so our community calendar our weekly feature here, letting you know events that are coming up, resources of all good things happening in our community. The second annual Youth Entrepreneurship Education Summit is Friday, still time to get tickets to attend the luncheon, and the presentation on the unsold mindset. I'm looking forward to hearing that. So also, timely enough, you want to run a home daycare business and you live in Central California, there's grants available. Really, this Nurture program, we've had them on the webinar before. Running a daycare business from your home really helps you with accelerating the licensing and also learn the business side of running a home daycare. It's a self-paced startup grants available. And really, it focuses on making the entrepreneurs learn about how to make money in this particular type of business where you provide good for all out there. So really, there is a shortage and really looking to improve that. You can't do anything more than actually train more to become good daycare business operators. And here's your chance. And so contact Nurture, and they have a program that's starting up right now, September 18th. So also our City of Bakersfield grant program, the Foodservice Management Program, offered through our friends at CSU Bakersfield through the Extended Education Global Outreach, also in partners with the SBDC here. It is starting this week, so there's opportunities if you want to go through and learn how to really become an effective and really sharp food service operator. Focuses on the business side, the business skills that you need to run a successful food business. Our free human resource hotline is available. There are the numbers throughout Central California. Numbers that we've partnered with the California Employment Association to provide help to employers. There's no cost at all. Just a quick note on the SBA disaster program we talked about. Here's a quick look at some of the programs that are available to small businesses, homeowners, renters, and others. This is the only SBA program, the only small business administration program that will actually make loans to homeowners and renters beyond small businesses. A lot of programs. We'll touch on this a little heavier next week when we have a little bit more time. All of our webinars go to live, at least all of them that I remember to record, at the CSU SBDC YouTube channel. There you will find about 240 plus videos. Most of the webinars are there. Go there and subscribe and have the webinar come to you. Also, if you appreciate the webinar, we'd love to hear your feedback. Well, and even if you have some suggestions that are not so appreciative, contact me. I'd love to hear your comments. Well, you look for the survey after the email or go to Google and give us some love. And there is really, really, when you talk about the disaster, there it is right there. So since I didn't have a quiz today or a actual poll, here's a little pop quiz for you. And I want you to just think, you don't have to answer. There's no way to answer this. What does $170 million look like? I've already replied to yes, I don't know. Yeah, I don't know. And but B might be, it depends on large or small bills. As we get ready to introduce our special guest today, Sarah Sims, maybe she knows what $170 million looks like, or possibly this guy, yes, Nick Bosa, who just signed the richest contract in the National Football League from a defensive player perspective. Last year, apparently, by that gesture, he didn't know what $170 million looks like, but he knows now. So that brings us to today's special guest. Sarah Sims joined the Federal Reserve Bank of San Francisco's Community Development Department in 2021 in a role as the Community Development Finance manager. She is responsible for identifying finance and investment needs across the district. Prior to joining the Fed, she spent 10 years structuring and managing the life cycle of impact-focused investments at Low Income Investment Fund. which is a national CDFI, Community Development Financial Institution. Worked with several other things and received her undergraduate studies in Wellesley College and a master's, an MBA at Stanford University. Sarah, it's great to have you join us today. Thank you, and jump on in.
Great. Thank you, Kelly. I am glad to be here. I'm going to share my screen. Seems like you all have a lot of fun at these. So it's fun to join you for a webinar Wednesday. Can you all see my slides?
Perfectly.
Okay, terrific. Well, good afternoon, everyone. My name is Sarah Sims, as Kelly said, and I am part of the community development team at the Federal Reserve Bank of San Francisco. My work there focuses on issues related to access to credit and things like how do we build a more inclusive financial system. Over the past few years, I've also increasingly been focused on the small business sector, so I'm particularly interested to hear your thoughts and experiences today. I want to quickly note that the views expressed do not necessarily represent those of the Federal Reserve Bank of San Francisco or the Federal Reserve Board of Governors. So as Kelly mentioned, I'm excited to be here today to share important data on the small business financial conditions and financing needs based on findings from the Federal Reserve Small Business Credit Survey. I also want to note that the data that I'm about to share with you today is not possible without participation of small businesses such as yourselves and the partnership of organizations like CSU, Bakersfield, SBDC, who's going to help us reach small businesses through this year's survey. So I want to say a big thank you to Kelly and team for having me and for being a survey partner this year. I also want to note that I'm going to share a lot of data with you. There's a bunch of slides that have charts, and I know that staring at charts for 20 minutes can make anyone's eyes glaze over. So please, as I'm talking, keep track of your questions. I'd love to hear at the end what resonates, in terms of these are small business experiences. Does this resonate with you? Have your experiences been different? Any findings that don't make sense? Would love to hear that at the end. And there's I'm going to run through these slides very quickly because there's a lot here, but I will share the deck with Kelly and team, and they can send that out to you all so you can have these slides for reference if that's helpful. So I'm going to start with some background on what the Small Business Credit Survey is. Then we'll look at some national results and trends, and then we'll drill down into some California-specific results and hear how California businesses responded to these questions. The Small Business Credit Survey is a national survey that provides a detailed look at the performance and financing conditions from the perspective of small business owners. So the responses we're talking about today are for employer firms, which we define as those with between 1 and 500 employees. We also collect data on non-employer firms, and that information can all be found on our website. But today I'm focusing on our employer firm data. This is from last year. This data is from the 2022 Small Business Credit Survey. And I want to do a quick plug for this year's, the 2023 survey, which just opened last week. It's going to run through mid-November and would really love your help in driving small business responses so we can get even better data on small business needs. So as I mentioned, Kelly and team are going to be pushing out a link that allows you to take the survey, and we'd really welcome your participation, and please help spread the word to other small businesses you know. So the SBCS model, or Small Business Credit Survey, enables us to reach businesses that tend to be underrepresented in other surveys, so including businesses that are rural, startup, firms owned by women and people of color. And what we found is that when more kinds of businesses have a say, what we learn about the state of small business is more accurate and more actionable. So this data is really, really helpful for the field. The survey findings get coverage in major news outlets and really helps elevate the voices of small businesses across the country. It also helps inform policymakers on Capitol Hill and at the state level to the extent state level data is available. And we hear from lenders too about how they look at the survey findings to help inform their approach to small business lending. So we're going to start with national results. These are takeaways from businesses across the country. It was a pool of nearly 8,000 employer firms that responded to these questions. And you'll see some of the response levels vary by question. So at a high level, what we heard was that businesses are still facing challenges. Common operational challenges were hiring and retaining workers and supply chain issues. We also heard about financial challenges of rising costs. As the availability of pandemic-related financial assistance programs has declined, we're seeing an increase in firms that have applied for traditional financing. This past year, we saw demand for financing rise above what it was pre-pandemic. Approval rates have also risen, but the share of applicants fully approved for financing remains lower than before the pandemic. So this means that small businesses are still not getting all the financing they're seeking. We are also continuing to see lower approval rates for firms owned by people of color. Let's start with a quick look at how small businesses are doing financially. This chart shows self-reported financial condition at the time of the survey. And as you can see here, financial condition is relatively unchanged from the previous two surveys, which were at the height of the pandemic. More than half of small businesses nationally are reporting that their financial condition is poor or fair. This chart shows financial condition by race and ethnicity of owner. You can see that a higher share of firms owned by people of color are represented in the poor and fair categories. So in 2022, we did see an improvement in profitability. 45% of employer businesses were operating at a profit at the end of 21, which was an increase of 10 percentage points from the end of 2020. So that was a positive increase. Profitability gains were evident across a variety, all industry categories. You can see a few examples here, but this was a trend that we saw across responses from a wide range of industries. The net share of profit improved, but we did see a decline in growth expectations from small businesses. So the net share of small business owners expecting revenue growth, which is you can see here as the blue line, fell from 42% last year to 35% and remains significantly below what it was pre-pandemic. And the net share of firms anticipating employment growth, which is the orange line, also declined, falling from 31% in 2021 to 27% in the 2022 survey. And some of that probably was a result of some of the challenges that we know small businesses have faced. And we're going to talk about those for a minute. 94% of small businesses nationally reported they experienced at least one operational challenge in 2022. So tight labor market and supply chain issues topped the list of operational challenges in 2022, and this was the same last year, so that these issues persisted. The waning impact of the pandemic on firms' operations are evident in the declining share of firms that reported challenges with things like complying with government regulations. You can see here that was at 29%, but in last year's survey, that was at 40%. So decrease there. And similarly with ensuring the health and safety of customers and employees, that was reported at 18% this year, or in 2022, excuse me, but in 21, that was 38%. So starting to see some of those challenges drop down. This chart shows the change in firms' experiences with hiring new workers. So across all 3 years, firms were similarly likely to have attempted to hire, but in 21 and 22 survey years, the firms found hiring to be more difficult. And in 2022, we did see some, but however, we did see some decline in the share of firms that said hiring was very difficult. So that was a little bit of an improvement in the 2022 data, that decrease in very difficult to hire. In addition to operational challenges, the survey also asks about financial challenges. And what we heard was 94% of small businesses experienced at least one financial challenge in 2022. Paying operating, cost of goods, as we talked about it, that was a big challenge. Paying operating expenses and handling uneven cash flows were all cited as challenges that firms faced. Here's a look at financial challenges broken out by the race or ethnicity of the business owner. And you can see from this chart that one of the challenges, in particular credit availability, was more likely to be a challenge for firms owned by people of color than it was for white-owned firms. So what did businesses do to deal with these financial challenges? In response to the challenges experienced in 2022, over half of the impacted firms, about 56%, reported that they raised their prices. Over half of small businesses also reported that they relied on owners' personal funds to help cover funding gaps, and about 4 in 10 firms obtained funds that will need to be repaid, so a loan or some other kind of debt. as opposed to, some of the pandemic assistance that we've seen as well. Okay, let's look a little bit more at what trends we saw in debt and financing. So this slide shows the types of financial service providers that small businesses use for their services. Again, this is national, and that includes things like payment processing, business loans, and payroll services. So most firms reported either using a large or small bank as their main financial services provider. And beyond banks, we saw 24% of firms relied on a non-bank financial company like a fintech or a payment processing company for their financial services. And then 13% reported that they used a credit union. The 2022 survey also asked respondents about sources of funding that they've used over the past 5 years. So this is a sort of looking back over several years question. They compared it with 2019, which was the last time the question was asked. And in 2019, respondents were most likely to rely on funds from financial institutions or lenders, followed by funds from the owner's savings or friends and family. However, in 2022, we found in the 2022 survey, we found that respondents were more likely to use funds from an owner's savings, friend or family, or government funding source than they were to rely on a financial institution. So that was a change. This rise in reliance on government funding is not hugely surprising, given we all know there was this increased availability of pandemic-related assistance through PPP and the EIDL loans and the various sources of support that were available to businesses. Firms owned by people of color, women-owned firms, and younger business owners were more likely to rely on the owner's personal sources of funding than their counterparts. And importantly, these differences are explained, at least partially, by differences in firm size and age. So we found in the data that Black and Hispanic-owned firms tend to be smaller and newer, for example, than white-owned firms, and women-owned firms are typically newer and smaller than men-owned firms. And we know that firms that are just starting out and those that are very small tend to have shorter credit histories and fewer financial services relationships, and so then therefore tend to have less access to financing and be more likely to rely on personal sources of funding. And this is a slide, this is as you'd expect, just showing that the reliance on pandemic-related financial assistance has declined as the programs that these, the programs meant to support businesses have ended. So for example, we saw the Paycheck Protection Program closed in May 2021. So there's a big drop off, which again, not hugely surprising. In looking at applications for traditional forms of financing, so this question excludes any applications for pandemic-related financial assistance. The 2022 survey finds that financing demands rebounded even beyond pre-pandemic levels. So you can see here in this chart that the demand rose from 25% last year to 40%, which is the highest it's been in the past 5 years. So we saw a really big increase in demand for private sources of credit and capital. And this chart provides some additional context on the types of financing that small businesses most commonly sought. You can see here lines of credit, business loans were most common, and then followed pretty closely by SBA financing. This chart tells us a little bit about the reasons that firms applied for traditional financing, and again, worth noting that firms could select multiple options here. As you can see, the most common reason was to meet operating expenses. That's something that was a trend during the pandemic and has continued. And then this one, it rose to 65% in the 2022 survey. So this is the highest percentage that we've seen in the last, as long as this question's been included in the survey. This chart shows the types of credit sources at which firms sought loans, lines of credit, and merchant cash advance. So of those that reported that they did seek financing, this breaks down where they went for that financing. So as you can see here, nationally, employer firms most often sought financing from banks. And this is a finding that is consistent with prior year surveys. 43% applied at large banks, and then additional 30% applied at small banks. This slide, there's a lot going on here, but this slide really tells us, the factors that influenced why firms applied to different lenders. So you can see At both large and small banks, the most common reason firms applied was because they had an existing relationship with the lender. By contrast, the top factor influencing a firm's decision to apply to an online lender was the speed at which they anticipated receiving the decision and or the funding. So different factors impacting different sources. This chart shows how access to financing has changed over time. So specifically, it shows the share of firms that were fully approved, partially approved, or denied for the financing that they sought. So you can see here the green and yellow areas on the chart reflect the share that was fully or partially approved. And it's the highest it's been since the 2020 survey. So as I mentioned earlier, we've seen an improvement in the share that were partially approved. And the share of outright denials fell from 34% to 21%. However, the share of fully approved for all the financing they sought, which is that green bar, remains below pre-pandemic levels. And as we saw just previously on the chart of financing outcomes over time, the share of fully approved firms declined across all firms through 2022. But we also saw, when you broke down the data, that declines varied by race and ethnicity of owners. So Black-owned firms were the least likely to be fully approved in 2019 and experienced the largest decrease in the share of fully approved. In 2022, 1 in 5 Black-owned firms were fully approved, compared with nearly 3 in 5 white-owned firms. Among firms that were approved for financing, applicants that applied to small banks were most satisfied with their experience, following applicants that applied to large banks and finance companies. Online lender applicants were typically most critical of their experiences, with just under half saying that they were satisfied. And over time, we've seen satisfaction levels are consistently highest at small banks. Applicant satisfaction with non-bank lenders, finance companies, and online lenders really declined during the pandemic. And we've seen some rebound in the satisfaction with banks, but with those lenders, but it still remained below business satisfaction with the banking experience with banks. Okay, so those were some sort of high-level national trends, some findings from the 8,000 employer firms that responded. Now let's take a look at what California firms specifically had to say to these questions. Some of the questions are going to be similar. What we can report really depends on the number of responses we have. So there's not the same level of data for California specifically. We had 753 responses in California in 2023. We had 744 last year, so pretty close in terms of number. And we had compared with 350 in 2020. So we've seen a big increase, which is great. The more responses we get, the more data we can share and unpack and really sort of get some interesting findings out of. So that's why we're so excited to have partners help us drive responses, because the more responses we get, the more we can do with this data. Again, just sort of high-level findings that California firms in general face more financial challenges than employer firms nationally. Financial condition, similar to the national findings, was pretty much unchanged, but majority reporting fair or poor financial condition. And we did see that California firms were more likely to seek government funding during the past 5 years than other employer firms nationally. And just a quick look at demographics. I realize this is small and potentially hard to see, but just to show that California small business demographics are fairly reflective of what we see in firms nationally in terms of how long the business has been open, the number of employees, gender of owners. California businesses tend to be more racially and ethnically diverse than firms nationally, but that's really the one place here that we see a difference. A few more demographic factors. Again, pretty much tracking national trends, though slightly lower in terms of the share of rural businesses than nationally. And one way that California businesses differ a bit from national responses is on the impact of natural disasters. I know Kelly was talking about the storms we had back in the winter, and certainly California businesses are no stranger to natural disasters. And so we see here that 20% of California businesses in 2022 reported sustaining natural disaster-related losses, And this was higher than the national average, which was 14%. And as noted earlier, the majority of California firms reported their financial condition as poor or fair. And we see that a significantly larger percentage of California firms reported financial condition as poor compared with national firms. And just to note, these charts here are the blue is California business responses, and then we have this gray chart is to compare it to what we saw from the employer firms, just so you can get a sense of how California responses are stacking up to the national pool. Just to look at some of the challenges, again, fairly similar to what we saw on the national, in terms of national trends. Operational challenges are pretty consistent with what businesses are experiencing across the country. And similarly on financial, on financial challenges, I think we saw increased costs, challenges paying operating expenses rising to the top. So pretty consistent here with national findings. We did see that California firms are more likely to use personal funds in response to financial challenges than firms nationally. And then a quick look at debt and financing. So the same percentage of firms reported using large and small banks compared with 2021 findings. What we see here is consistent. There was no real change in the percentage of firms that were going to large and small banks. And we did see a slightly higher rate of credit union usage versus 2021. So last year, about 9% of small businesses reported using credit unions, and this year that's up to 13%. And then we did also see in 2021 that 3% reported that they use CDFIs for financial services, and that is not seen in the 2022 data. We also, as I noted previously, the California firms reported that they're more likely to access government funding sources than the national firms. And in general, we saw that California firms sought more pandemic-related financial assistance than their peers nationally. Again, it varied a little bit by type of financial assistance, but you can see here generally that Californians were reporting higher percentages for various sources than their peers nationally. Demand for traditional financing was very much in line with national employer firms. So about 42% of California businesses reported applying for some type of loan, line of credit, or cash advance, compared with 40% nationally. So pretty consistent there. And then California businesses were slightly more likely than firms nationally to seek a line of credit or an SBA loan, as opposed to just a traditional business loan from a bank or other source. And again, similar to national trends, the most common reason for applying for financing was to meet operating expenses. That's something we saw across the board. Although it's worth noting that quite a few did seek funding to expand businesses, which is an encouraging sign. And California firms were considerably more likely to use an online lender, which is interesting. So if you look here, that the blue 37% of California businesses reported that they used an online lender, compared with just 22% of firms nationally. And they were also considerably less likely to use a small bank, which was sort of an interesting finding. And finally, California firms were less likely to be fully approved for financing than their peers nationally. 39% reported full approval of the financing they sought, compared with 53% nationally. So that was a lot of information. I just want to close by saying that we have a lot of resources. As I mentioned, this is a robust survey. We do it annually, and every year there's a team out of the Cleveland Fed that runs the survey, and it's a collaboration of all the 12 Federal Reserve banks, but there's a team dedicated to managing the survey. They do the data analysis, and they publish a whole host of reports that are a great resource. So if you're looking for small business data, whether it's national or California, I encourage you to check out the resources they have. We also this year for the first time have data by MSA for some of the MSAs in California. So they're trying to get down to even more localized data. We hear a lot from our small business ecosystem partners that we really want local level data. And so trying to figure out ways to drill down. And of course, the more responses we get, the more likely we are able to do that. So, and then just finally, one last plug, please help us with this year's survey. We'd love to hear from you, from businesses you work with, and please watch for the survey link. So with that, I will turn it back to you, Kelly.
Fascinating stuff. Absolutely fascinating. And we will be promoting the survey. You'll see links in the webinar and other sources. And one of the great value points for our participating with the Fed in this is that, number one, is that we can get individual information for our marketplace by being a partner if we have a sufficient sample size. So we do need a sample size. We do need those of you that work with small businesses to work with us on getting this out. And the bigger the response, the more reliable the data, as Dr. Evans would tell me. So the larger the sample size, I think we need a minimum of 50. We need to shoot for a higher number than that. There was some fascinating data compared in California to the nation. I want to see if that continues to hold true in future subsequent years. Those that have been on our webinar that were here every week during the pandemic and through the pandemic relief program, you do know that for a lot of our poll questions, we would go to the National Federation of Independent Business, who conducted a COVID survey and asked many of the same questions. And we found that locally, a lot of what was happening nationally was happening locally. And, it didn't overly surprise me because we know that, in the central and southern San Joaquin Valley, there's a lot of test data because our data, for some reason, holds true nationally. We really need this information to find if that is really holding true with accessing capital and a lot of the resources that are available. Okay, there's still time to get some questions in. One of the things, Sarah, that really stuck out to me was the increase, which shouldn't be a surprise, but when you were talking about the profitability and really pulling out the leisure and hospitality sector, and that was an increase from 14 to 25% of firms were profitable. And overall, you had to go to manufacturing even to get someone close to 50% of the firms that were profitable, which is a huge issue, at least from my standpoint, and how we can actually use this data to hopefully improve the profitability of those firms.
So Kelly, I'm curious, did this resonate? These findings resonate with what you and your colleagues on the webinar are seeing in the markets that you serve? Did this feel, again, understanding that this data is from 2022, so it's not current in terms of what's happening now, but thinking back to 2022, did this feel largely like these trends were applicable and consistent with what you're hearing from businesses?
Many of them, yes. I would need more time to digest the data.
You mean you didn't process 50 slides in 2 minutes?
Like I need another lifetime to digest the data. But in the absence of another lifetime, I think some of the things that jumped out were the profitability and the need, because I think the hospitality industry is still hammered.
Still struggling. Yes, we've heard that.
Still 25%, 3 out of 4 hospitality businesses in 2022 were unprofitable. And going forward, that is not something that is going to work well. And it's reflective in some of the programs that we offer and working with CSUB's extended education global outreach in that restaurant program, for example, is meaning to improve a lot of the things that we see. But really, this data, I think, really can link toward really working toward a lot of more profitability strategies. Maybe we could offer, and it's really something that we can do to help out and really offer. Maybe it looks like there's going to be a greater need for turnaround businesses that are unprofitable now and really need some turnaround strategies. Many of the lending programs, for example, CDFIs, which you're well familiar with, and they are, as far as lenders, they're going to be a nonprofit lender that give you the greatest opportunity of a questionable application. For example, if let's say a borderline as far as approvability on that CDFI, we're up to 3 now in Kern County, whereas we only had 1. And
I was excited to hear that. Yeah, you mentioned that at the top that there was a new Valley Strong Credit Union is creating a new CDFI. Is that right? Or is a new CDFI?
So theirs has just
That's
been
great.
approved. Last year, we had Alta One Credit Union,
Okay.
which actually received funding through the last round of the Treasury funding, and their programs are now being introduced.
Terrific.
And then also Access Plus Capital out of Fresno has been in the
Yep.
marketplace for a while.
Yep.
So the CDFIs play a huge role, don't they, Sarah?
They absolutely do. They're a really important part of the sort of the access to credit ecosystem, and can be flexible, as you know, sort of in ways that sometimes banks cannot. So really, we'd encourage them, small businesses to sort of pursue all different options. But really, the CDFIs can be a great place to start if you're not fitting in a credit box for a traditional bank.
So being up against time and no questions, I know.
And I will say this happens, as I said, I did warn you, it was a lot of data. I think what we like to do is just, this is a chance to showcase some of the data, but just to show folks that this data exists and that you can go find it. And as I said, I'll share the slides because these can be used as reference, looking at when you have time to digest or when you need to reference some small business information. So please know that this survey is out here, and we really, we encourage everyone to participate because the more we hear from you, the more we can do with it.
And just looking through the chat box real quick to see what Maureen has offered as far as resources for you. There's SBDC signups. There is also more information on the food management program, Google reviews, Dr. Mark Evans data that he has in here. And also what we'll do is as we oftentimes do, like about every week, we will be sending out a resource of links. We'll have the link to the information that you can find on the Fed's website. We will have a link to the survey, so please participate in the survey. Other things, there'll be a link to this recording. And thank you, Sarah, for your slides. So all that will be coming to you in your email box soon this week. And so thank you so much for joining us.
Thanks for having me. This was fun, and appreciate the opportunity.
Let's get that data so we can get that data subset from the Fed, find out what some of our issues are, compare them to state and national after we're able to do that. So that's going to wrap it up. That's going to wrap it up. Thanks so much for joining us. Dr. Mark Evans, see you in 2 weeks. Fascinating stuff. Maureen and Iris, keep up the great work. So for all these fine folks, I'm Kelly Bearden. We will be back in all of next week and be back with another great program. We'll be talking about local marketing. We'll be coming to you from the Eastern Sierra, the fine county of Mono County, also Inyo over there. So we'll see you then. So for Sarah Sims, Mark Evans, I'm Kelly Bearden. We'll see you next week. Goodbye, everybody.